markets are on the verge of becoming as expensive as they have been in the past. So it has to be earnings growth that has to then lead from there. And you picked a couple of sectors where you think that earnings upside could come from. Financials, some parts of industrial. So I think energy, you said, correct me if I'm wrong, and you said consumer discretionary. Is that where you think that there is upside for the markets from here on?
So consumer discretionary, we are very clearly focused on, because that's the categorization in the market. So, but we are focused on four-wheeler autos basically, and of course financials and industrials. So I think these are three sectors where we think that earnings estimates can go up. But more importantly, I think the market will do well if the earnings estimates don't go down, right? Because what we found, and it's not a Nobel Prize winning finding. It is a normal thing that index EPS from the time that it is introduced, like FY23 is at plus 21. From the time it is introduced, it generally tends to fall 10 to 35% from there, right? Now the thing is, in such an environment, what is it? Which sectors drive that decline? And we found that 30 to 40% of index EPS integer decline is driven by private banks and consumer discretionary each, right? So the declines are very heavily skewed towards them. So if you are reasonably comfortable about those numbers, then the risk of a downgrade to 22 and 21 is lower, 20 or 23 is lower. And particularly, as I said early on, if 22 numbers, the GDP numbers themselves have to be bumped up, then I think in parallel, the 23 EPS also goes up, even if the year-on-year growth is not higher. So I think that is what the market will be geared to, and I think that will be driven by industrials, banks, and autos, four-wheeler autos.
Banks on the premise that asset quality strain has been less than feared. What about industrials and on autos?
So in industrials, I think that first the fiscal math is going to be very supportive. We haven't done the numbers, but I was sitting through a presentation by the Delhi research houses, and they've done this aggregation of state budgets, and they found that state capex is down 41% so far, right? So clearly, as the fiscal normalization happens, which I expect it to, and I think it's already happening, I think the outlook for government capex improves significantly. The second part to that is, as I said earlier, if the government is able to finalize these companies, the winners of these incentive schemes by March, they are going to be stampeding to do capex in FY22. And even for the handset scheme, you must have seen, one of the largest industrial houses, or largest business groups in India, has launched a new electronics company, which was formed in April 2020 with $1.5 billion of new capex. Now, when was the last time you heard of greenfield investments of that magnitude? Now, I don't know how over what period it will happen, or it will be successful or not, but they got 500 acres of land, right? The last I heard of this was like 2010, right? So I think as the investment, and there will also be competitive stresses, in the sense that there are companies which are waiting for the PLI schemes to get launched, the details to come out, because they think that if we are not able to compete, because if my competitor wins this, in 5 years' time, I will be 1/3 his size, right? And there are upstream investments. So if all of this cell phone assembly starts to happen in India, a lot of the upstream capex will start moving to India as well. So I think the industrials are likely to see, I think, significant move. Autos is more of a bet on the fact that a large part of the PLI budget has been allocated to autos, and we think that if it is, say, in car exports or even electric vehicles, I think the prospects and sentiments around that will improve.